market structure. Let's start with the basics. We have three main types of markets. We have a bullish market, a bearish market, and a ranging market. So we'll go through them one by one. And we'll start with a bullish market. A bullish market is when price is moving in an upwards direction, and that's when the buyers are in control. In a bullish market, price forms higher highs and higher lows. And that simply means each time price pushes up and makes a new high, and it's higher, next time it does that, the next high is higher than the previous high. And when it pulls back, it forms a low, but that low is still higher than the previous low. That is a pattern of higher highs and higher lows, and that tells us that buyers are in control and the overall direction of the market is moving upwards. So higher high, which is higher than the previous high, higher low, which is higher than the previous higher low, higher high, which is higher than the previous higher high, higher low, which is higher than the previous higher low. So that in the simplest of formats, that is your bullish market. It's a trending bullish market making higher highs, higher lows, higher highs, higher lows. Now the opposite direction is a bearish market, and that is when the sellers or the bears are in control. And in a bearish market, we're making lower lows and lower highs. And that means each push down goes lower than the last one, and each pullback forms a lower high before continuing lower again. And this pattern tells us it's in a downwards trend. So we've got a lower low, lower high. This next low comes lower than the previous low, lower low. It makes a lower high, which is still lower than the previous one. And we make a lower low, which is lower than the previous lower low. Then we make a lower high, which is lower than the previous lower high. And then a lower low. And that there, in the simplest format, is your bearish market. A nice trending bearish market, moving downwards, making lower lows, lower highs, lower lows, lower highs, lower lows. We then have a third type of market, and we call it a ranging market. This is where there's indecision in the market. Neither the buyer nor the seller are really in control, and price just bounces between support level at the bottom and resistance level at the top. We often call this a consolidation phase, and it's where the market is building up liquidity on both sides before the next big move up or down. So if you have a ranging market and it's been ranging for a very long time, depending on what time frame you're trading on, so let's say you was on the 15 minutes and it'd been ranging for a day or 2 days, or you're on the daily and it's been ranging for a month or 3 months, then you can expect quite a big move because it's built quite a lot of liquidity. People have got stop losses on either side of that market, of them trades now. So when the market has got money to go into. So for an example, let's say we had a level of resistance there, and we had a level of support there, and you'll see price, and for whatever time period, let's say this was been going on for three months, and price just keeps coming up and down like that, And that is what you call a ranging market. So if you imagine you've got traders who are trading this, you know, that there's types of strategies where you've noticed you're in a ranging market. So you're trading at the tops and you're selling at the tops and buying at the bottom. So you'll have people, they've got limit orders and they're setting limit orders and they've got a trade there and they're trading it to the top and they're aiming for it. And then you've also got the same, you've got sellers doing the same on that side. And then before a move, you'll usually see it might come up and it'll take all these out and then people will think it's broke out and the trading is going up. So all the buyers are happy and then more people come buying and it'll just go and it'll take all of them out as well. Likes to manipulate the market.